Welcome to the Finance Offer Podcast. In this episode, we are diving into the hidden mechanics of credit card annual fees and exactly how banks generate revenue from them. To understand how these systems really work behind the scenes, let's start with a scenario that happens to thousands of people every single day. Imagine you are walking through a busy airport terminal. You pass a crowded, noisy departure gate and see a sleek, frosted glass door leading to a premium airline lounge. To get inside, to access the free food, the quiet workspace, and the comfortable seating, you need a specific premium travel credit card. You apply from your phone, get approved instantly, and agree to pay a $600 annual fee. A few days later, your heavy metal card arrives in the mail. You get your lounge access, a generous travel credit, and a massive welcome bonus of airline points. You feel like you have successfully beaten the system and unlocked a lifestyle upgrade. But behind the scenes, the financial institution is looking at a very different picture. The bank just secured a highly predictable, risk-free stream of income before you even bought a cup of coffee with that new card. Today, we are going to unpack exactly how that upfront fee turns into massive institutional profit. This topic is critical right now because premium credit cards are no longer marketed as debt instruments. They are marketed as lifestyle products. Consumers willingly trade upfront cash for the promise of future travel perks and elite status. But there is a massive cost to misunderstanding this financial exchange. If you do not understand the math the bank is using, you are almost certainly subsidizing the rewards of other cardholders. The confusion exists because we are heavily trained to look at credit cards strictly through the lens of interest rates and late fees. We think banks only make money when we make a mistake and fail to pay our bill on time. But the annual fee operates in a completely different universe. It is a structural design that transforms traditional borrowing into a subscription model, giving the bank guaranteed revenue regardless of your financial behavior. First, to understand how this works, we have to separate bank revenue into two categories. There is contingent revenue, and there is non-contingent revenue. Contingent revenue happens when you take a specific action. If you carry a balance past the due date, the bank makes interest. If you swipe your card to buy groceries, the bank charges the grocery store a hidden processing fee. Both of those revenue streams require you to do something. If you simply put the card in a drawer and never use it, the bank makes zero contingent revenue. This is a problem for banks. Banks hate unpredictability. They want stable, guaranteed income. The annual fee solves this problem perfectly. It is the ultimate non-contingent revenue stream. It is a fixed, recurring charge levied simply for the privilege of keeping the account open. It does not matter if you spend $1 or $100,000. The bank has secured their baseline profit. Next, let us look at the exact timeline of how this money is captured. When you are approved for a premium card, the bank usually lures you in with a massive sign-up bonus. Offering you 80 or 100,000 travel points creates a massive financial liability for the institution. To offset that cost immediately, they post the annual fee to your very first billing statement. This charge reduces your available credit before you even make your first purchase. The bank immediately secures what accountants call an account receivable. Because you legally agreed to this fee when you signed the application, the bank has guaranteed that even if you extract the sign-up bonus and never use the card again, they have captured a predetermined amount of your money to cover their acquisition costs. Here is where the internal accounting becomes fascinating. The bank does not just take your $600 fee and declare it as instant profit on day one. Corporate accounting rules require them to spread that revenue out over the time the service is provided. This is called deferred revenue. The bank takes your $600 payment and officially recognizes $50 of revenue every single month for 12 months. By stretching this out, the institution guarantees a steady, predictable monthly income stream on its income statement. This creates a rock-solid financial foundation that completely shields the bank from economic downturns. If a recession hits tomorrow and people stop spending money on their credit cards, the bank still has millions of these subscription fees steadily trickling into their earnings reports every single month. Now we have to address the perks. This is the exact point where the math tricks most consumers. You look at a card with a $600 fee, but you see a $300 travel credit, a $200 hotel credit, and lounge access. You calculate that the perks add up to more than the fee, so you assume the bank is losing money on you. They are not. The bank is playing a game called wholesale arbitrage. When a major financial institution buys airport lounge access or statement credits from an airline, they do not pay the retail price that you would pay. They buy these perks in massive, multi-million-dollar bulk contracts. They get extreme wholesale discounts. A perk that you value at $100 might only cost the bank $25. They are packaging wholesale services and selling them to you at a markup, disguised as an annual fee. Furthermore, the bank relies heavily on a concept called breakage. Breakage is the statistical, mathematical certainty that a large percentage of human beings will simply forget or fail to use all the perks they paid for. You might remember to use your airline credit, but you might forget to use your monthly dining credit. Every dollar of a perk that you fail to redeem is pure, unspent profit that the bank gets to keep. This is exactly why the terms and conditions on these perks are so frustrating. The credits expire at the end of the month, or they only apply to specific incidental fees, or they require you to book through a specific portal. These rigid, annoying rules are not accidents. They are intentionally designed by actuaries to increase the probability of breakage. Next, we reach the renewal cycle. At the 12-month mark, your fee automatically renews. The bank relies entirely on human inertia. They know that if they sent you an invoice and asked you to proactively write a check for $600 to renew your card, millions of people would cancel. By making the billing automatic, they secure another year of revenue before you even realize the year has passed. And here is the secret about year 2. The bank does not have to pay you another massive sign-up bonus. Because their acquisition costs drop to zero after the first year, the profit margin on your annual fee in year 2, year 3, and beyond is significantly higher than it was in year 1. Finally, there is a hidden compounding effect. If you pay your statement balance in full every month, you avoid interest. But if you carry a balance, things change drastically. Because the annual fee is added to your statement balance, if you do not pay the full statement, that fee begins generating interest. The bank applies your standard purchase interest rate to the unpaid portion of their own fee. Over a prolonged period of minimum payments, the bank is quite literally earning compounding interest on the fee they charged you. When you pull back and look at the broader picture, you see why this system is structurally brilliant for the institution. The upfront fee profoundly alters your behavioral economics. It triggers the sunk cost fallacy. Once you hand over $600, you experience a strong psychological mandate to earn that money back. How do you justify the cost? You consolidate all of your daily spending onto that one specific premium card to accumulate points. This behavior is the ultimate structural incentive. By charging you a high fee, the bank guarantees what the industry calls top-of-wallet status. Because you are trying to justify the fee, you abandon your other credit cards. When you channel all your spending through this one card, the bank collects massive processing fees from every merchant you buy from. The annual fee is not just a direct revenue stream. It is a psychological catalyst designed to maximize how often you use the card. Additionally, this fee acts as a protective barrier for the bank. Consumers who are willing and able to pay a large upfront fee for travel perks generally have higher disposable incomes and stronger credit histories. By putting a high price tag on the door, the bank filters out risky borrowers, creating a portfolio of highly reliable customers who are statistically much less likely to default on their debts. What you now understand is that a credit card annual fee is not just a toll gate to access a few travel rewards. It is a highly engineered financial mechanism. It transforms unpredictable consumer borrowing into a highly stable, highly predictable subscription business. When you evaluate premium credit card offers in the real world moving forward, you can see straight past the marketing brochures. You know that the institution is calculating wholesale costs, they are modeling your probability of breakage, and they are banking heavily on your psychological need to justify the upfront cost. You now have the structural clarity to evaluate these products not based on the emotional appeal of luxury, but on the cold, hard math operating behind the scenes. If you found this breakdown helpful and want to continue learning how the financial system really works, please hit that subscribe button, give this video a like, and leave a comment below with a financial topic you want us to cover next. Thanks for watching the Finance Offer podcast, and we'll see you in the next episode.